You've got $10,000 sitting in your bank account and $18,000 in credit card debt, charging you 18% interest. Should you invest that $10,000 in the stock market or kill the debt? Ray Dalio's answer might surprise you, and the math behind it will change how you think about money forever. December 20th, 2025. You're sitting at your kitchen table. There's $10,000 in your checking account. Your bonus just hit, and you're staring at two options. Option 1, put that money in the stock market. The S&P 500 has averaged around 10% historically. Maybe you get 12% if you're lucky. Build wealth. Let compound interest work its magic. Option 2, take that $10,000 and immediately pay down your credit card debt. You've got $18,000 sitting there at 18% interest. Every month you're paying $270 just in interest, not touching the principal, just interest. What do? Most people go with their gut. They listen to that voice in their head, the voice that says, "The market's hot right now, I should invest. I'll pay off the debt later." Or maybe it's the opposite voice. Dave Ramsey says debt is evil, kill it immediately. But Ray Dalio doesn't operate on gut feelings. He operates on math. Cold, systematic, ruthless math. And when you actually run the numbers the way he would, the answer becomes absolutely clear. Here's the thing that blows my mind. This isn't a complicated question. It's pure mathematics, but almost nobody frames it correctly. They turn it into an emotional decision when it should be a mathematical one. So let me show you exactly how Ray Dalio would think about this, because once you see the framework, you'll never look at debt and investing the same way again. Okay, so let me start with the fundamental principle that Ray Dalio would apply to this entire question. It's so simple, it sounds almost stupid when you say it out loud. Ready? Compare the guaranteed return against the uncertain return. That's it. That's the whole framework. But let me break down what that actually means. When you pay off debt, you're getting a guaranteed return equal to the interest rate on that debt. If your credit card charges 18%, paying off $1,000 of that debt gives you a guaranteed 18% return. Not an average return, not a hopeful return. Guaranteed. That $1,000 will never accumulate 18% interest again. When you invest in the stock market, you're getting an uncertain return. Sure, the S&P 500 has averaged around 10% over the long term, but that's an average. Some years it's up 30%. Some years it's down 37%, like in 2008. You don't know what you're getting. Now here's where it gets interesting. Ray Dalio built Bridgewater Associates on risk-adjusted returns. Not just returns, risk-adjusted returns. What does that mean? It means he's always asking, what's the return relative to the risk I'm taking? A guaranteed 18% return by paying off credit card debt? That's phenomenal on a risk-adjusted basis. There's literally no investment in the world that gives you guaranteed 18%. None. The safest investments, government bonds, are paying around 4 to 5% in 2025. Corporate bonds might pay 6 to 8%. Stocks might average 10 to 12% over decades, but with massive volatility. 18% guaranteed beats all of that, every single time. But wait, you might be thinking, what if the stock market goes up 25% next year? Then I should invest, right? And this is where people get trapped. They're comparing best-case investment scenarios against average-case debt scenarios. That's not how Dalio thinks. He thinks in probabilities, in risk-adjusted outcomes. Let me give you the actual math. Say you've got $10,000. You invested in stocks, hoping for 12% returns. In 1 year, if everything goes perfectly, you've got $11,200. You made $1,200. But that same $10,000 in credit card debt at 18%, in 1 year, it grows to $11,800. You lost $1,800. Net difference? Negative $600. You're behind, even in a good market year. And here's the killer. That debt compounds against you every single month. Not every year, every month.
which means the effective annual rate is even higher than 18% because of monthly compounding. This is what Dalio understands that most people miss. Compound interest works both ways. It can build wealth or destroy wealth. And when you've got high interest debt, it's destroying wealth faster than most investments can build it. Think about that for a second. You're running on a treadmill that's tilted against you. Every month, you're falling further behind, and the only way to stop falling is to get off the treadmill entirely. Pay off the debt. Now, I want to be clear about something. Not all debt is created equal, and this is where Dalio's framework gets more sophisticated.
Ray Dalio doesn't say all debt is bad the way some financial gurus do. He's way more systematic than that. He built a $150 billion hedge fund by being systematic. So his approach to debt is, you guessed it, systematic. Here's the decision tree he'd use. I've studied his principles, his investment philosophy, his risk parity approach. And when you distill it down to personal finance, this is what you get. Step 1. List all your debts with their interest rates, not just the total amount, the actual interest rates. Credit cards, student loans, car loans, mortgage, everything. Step 2. Compare each debt's interest rate to realistic investment returns. And I mean realistic, not best case, not the market could go up 20%. Realistic expected returns based on historical averages and current market conditions. Step 3. Apply the risk adjustment. A guaranteed return is worth more than an uncertain return. So if your debt interest rate is within a few percentage points of expected investment returns, the debt payoff wins because it's guaranteed. Step 4. Consider the time horizon and liquidity needs. This is where it gets interesting. Let me walk you through this with real numbers for 2025. Credit card debt, usually 15 to 25% interest, sometimes higher. Let's use 18% as our example. Student loans varies wildly. Federal loans might be 4 to 6%, private loans could be 8 to 12%. Mortgage. In 2025, you're looking at around 6 to 7% for a 30-year fixed mortgage, maybe lower if you locked in a few years ago. Car loans, usually 4 to 8%, depending on credit score. Now let's look at realistic investment returns in 2025. The stock market has historically averaged around 10% annually over very long periods, but that includes massive ups and downs. In any given year, you can see anything from negative 30% to positive 30%. If you're diversifying the way Dalio recommends with his all-weather portfolio, you're looking at more conservative returns, 7 to 8% annually with much lower volatility. That's 30% stocks, 55% bonds, 7.5% gold, 7.5% commodities. So here's how the math shakes out. Credit card debt at 18% versus stock market at 10% expected. Pay the debt, not even close. You're guaranteeing yourself an 18% return versus hoping for 10%. The 18% is worth way more on a risk-adjusted basis. Credit card debt at 18% versus all-weather portfolio at 7 to 8%, still pay the debt. Guaranteed 18 beats uncertain 7 or 8 every single time. Student loans at 6% versus stock market at 10% expected. Now it gets interesting. You've got a 4 percentage point spread. This is where Dalio's risk adjustment comes in. Is the uncertain 10% worth more than the guaranteed 6%? Maybe. Depends on your risk tolerance and time horizon. If you're young with decades ahead, maybe you lean toward investing. If you're closer to retirement, maybe you lean toward guaranteed debt payoff. Mortgage at 6.5% versus all-weather at 7 to 8%, here's where Dalio would say invest. You've got a small spread, but mortgages have another factor. They're tax deductible for many people. If you're getting a tax deduction on that 6.5% interest, your effective rate might be closer to 4.5% or 5%. Now the all-weather portfolio's 7 to 8% looks pretty good. But there's one more massive factor in this decision tree that changes everything, and this is pure Dalio thinking. Let me tell you about what I call Dalio's 18% rule. It's not something he's explicitly named, but when you study his risk management philosophy and apply it to personal finance, this pattern emerges. Any debt with an interest rate above 12 to 15% should be eliminated before you invest a single dollar. Why? Because you cannot reliably beat that return in the market on a risk-adjusted basis. Look at Pure Alpha, Dalio's flagship fund. It averaged around 12% annually from 1991 to 2020. 12%. And that's run by some of the smartest quantitative analysts in the world with billions in resources. You think you're going to consistently beat 18%? You're not. Nobody is. Not reliably, not systematically. So here's the harsh truth. If you've got credit card debt, you need to kill it before you invest. I don't care if your friend told you about some hot stock. I don't care if Bitcoin is rallying. I don't care if you're missing out on gains. You're hemorrhaging money faster than you can make it. Let me show you the actual numbers because this is where it gets brutal. Say you've got $20,000 in credit card debt at 18%. You're making minimum payments of $400 a month. You know how long it takes to pay off that debt? 29 years. You know how much you'll pay in total interest? $34,000. You borrowed $20,000, you're paying back $54,000. The credit card company is making a $34,000 profit off you. Now, same scenario, but instead of minimum payments, you take any extra money you have and aggressively pay down that debt. You find an extra $500 a month. Suddenly, you're paying $900 a month total. You know how long it takes now? 2 years and 4 months. You know how much interest you pay? $4,400. You just saved almost $30,000 in interest by being aggressive about debt payoff. That's a guaranteed $30,000 return over the alternative. Show me an investment that guarantees you $30,000 over 2 years on a $20,000 principal. It doesn't exist. This is what Dalio means by systematic thinking. You're not making an emotional decision. You're running the numbers. The numbers are screaming at you to pay off the debt. But here's what's fascinating. Most people don't do it. You know why? Psychology. The same psychology that makes people bad investors makes them bad debt managers. They see their friend posting on social media about stock gains. They see headlines about the market hitting all-time highs. They get FOMO, fear of missing out. They think, I need to invest now or I'll miss the boat. Meanwhile, they're sitting on credit card debt that's compounding against them at 18% monthly. They're focused on the shiny object, the potential gain, while ignoring the guaranteed loss. Dalio talks about this in his Principles book. Pain plus reflection equals progress. You have to feel the pain of compound interest working against you, really feel it, calculate exactly how much you're losing every single month, and then reflect on it. That reflection creates the urgency to change behavior. I spent hours running these numbers when I was researching Dalio's approach, and honestly, it changed how I think about debt entirely. Because once you see it as a guaranteed negative return compounding against you, you can't unsee it. Here's another way to think about it. Paying off 18% debt is like getting an 18% raise, tax-free, guaranteed, every year until that debt is gone. Would you turn down an 18% raise? Of course not. But that's exactly what you're doing when you invest instead of paying off high-interest debt. Okay, so we've established that high-interest debt needs to die. But what about low-interest debt? This is where Dalio's framework gets really interesting. There's a concept in finance called good debt and bad debt. Bad debt is consumer debt. Credit cards, car loans for depreciating assets, personal loans for vacations. That's bad debt. It's financing consumption. Good debt is debt that finances assets that appreciate or generate income, mortgages on real estate that appreciates, student loans that increase your earning potential, business loans that generate revenue. Dalio doesn't talk about this in moralistic terms like good or bad. He talks about it in terms of returns. What's the return on the debt? If you take out a student loan at 5% interest, but that degree increases your lifetime earnings by $300,000, the return on that debt is massive, way more than 5%. If you take out a mortgage at 6% interest, but the house appreciates at 4% annually, and you're getting tax deductions on the interest, plus you're building equity instead of paying rent, the effective return might be positive. This is where the decision flips.
Low-interest debt that's financing appreciating assets or income generation can actually be leveraged to build wealth faster. Let me give you a concrete example. It's 2025. You've got a mortgage at 3.5% that you locked in back in 2021 when rates were low. You've also got $50,000 in a savings account earning nothing. Should you pay off a chunk of mortgage or invest that $50,000? Dalio's framework says invest. Here's why. Your mortgage is 3.5%, but you're getting a tax deduction on that interest. If you're in the 22% tax bracket, your effective interest rate is really only 2.7% after taxes. Now you take that $50,000 and put it in an all-weather portfolio. Conservative estimate, 7% annually. You're netting a 4.3% spread between your effective mortgage rate and your investment return. Over 20 years, that spread compounds into enormous wealth. That $50,000 at 7% becomes $193,000. Meanwhile, your mortgage gets paid down on schedule with inflating dollars. You're effectively paying off the loan with cheaper money as inflation erodes the real value of those payments. This is how wealthy people think about debt. They use low-interest debt as a tool to amplify returns. They're not scared of debt, they're strategic about it. But notice the difference. We're talking about 3.5% mortgage debt, not 18% credit card debt. The interest rate makes all the difference. Here's Dalio's cutoff based on my analysis of his risk parity approach. If debt interest is below your expected risk-adjusted investment return by at least 2 percentage points, you should generally invest instead of paying off debt early. Mortgage at 3%, investments expected at 7%, 4-point spread, invest. Student loans at 5%, investments expected at 7%, 2-point spread, probably invest, especially if you're young. Car loan at 7%, investments expected at 7%, no spread, pay the debt because it's guaranteed. Credit cards at 18%, investments expected at 7%, negative 11-point spread, absolutely pay the debt. This systematic framework removes emotion from the decision. You're just comparing numbers.
Now, here's where Dalio's thinking adds another layer that most financial advisors miss: the critical mass principle. Ray talks about this in terms of compound growth. There's a threshold amount of capital where compound interest starts to really accelerate. For most people, that threshold is around $100,000. Why 100,000? Because of the math. If you're getting 10% returns annually, $100,000 becomes $10,000 in gains per year. That's real money. That's noticeable wealth building. But when you've got $10,000, 10% is only $1,000 a year. It's harder to feel the momentum. The first $100,000 is the hardest to accumulate. The second $100,000 comes faster. The third, even faster. That's the power of compounding once you hit critical mass. So here's the strategic question. Should you delay hitting critical mass to pay off low-interest debt? Dalio would say it depends on the opportunity cost. If you're 25 years old with student loans at 4% and no other savings, you might want to balance debt payoff with hitting critical mass faster. Why? Because you've got 40 years until retirement. Starting with $100,000 at age 28 instead of age 35 is the difference between having $2.2 million and $1.4 million at age 65. That's an $800,000 difference for starting 7 years earlier. The compound curve is exponential. The earlier you hit critical mass, the more you benefit from that exponential growth. But if you've got high-interest debt, it doesn't matter. The 18% compounding against you will destroy wealth faster than you can build it. You'll never hit critical mass because you're running backwards. So the framework becomes eliminate high-interest debt first, build 3 to 6 month emergency fund second, then balance low-interest debt payoff against investment for critical mass. Once you hit critical mass, let compound interest accelerate your wealth. This is systematic. This is how you build wealth deliberately instead of hoping for it. Let me bring this into 2025 specifically, because the environment matters. Interest rates have been volatile. The Federal Reserve raised rates aggressively in 2022 and 2023 to fight inflation. Then they started cutting in late 2024. Now we're in this weird middle zone. Mortgage rates are around 6 to 7% for new loans. Credit card rates are still brutal, 18 to 25%. Student loan rates depend on when you borrowed. Federal loans from the last few years might be 5 to 6%. On the investment side, the stock market has had a strong run, but valuations are high. The S&P 500 PE ratio is above historical averages. That doesn't mean a crash is coming, but it does mean future returns might be lower than historical averages. Bonds are paying around 4 to 5% for investment-grade corporates. Treasury bonds are in the same range. So what does this mean for the debt versus investment decision? Credit card debt? Still a no-brainer. Pay it off. 18% guaranteed return beats everything available in 2025. Student loans at 5 to 6%? This is closer. Stock market expected returns might be 7 to 9% given current valuations. That's a small spread. You could go either way depending on your risk tolerance. Dalio would probably lean toward a balanced approach. Pay extra on the loans while also investing some money to start building critical mass. Mortgage at 6 to 7%? If you're getting a tax deduction, your effective rate might be 4.5 to 5%. Investing in a diversified portfolio with 7 to 8% expected returns makes sense. Don't rush to pay off the mortgage early. The key insight for 2025 is that we're not in a low interest rate environment anymore like we were from 2008 to 2021. Debt is more expensive now, which actually makes the decision easier for most people. If you took out debt in the last 2 years, you're probably paying higher rates. That tilts the decision toward debt payoff more than it would have 5 years ago. But if you locked in a low rate back in 2020 or 2021, like a 3% mortgage, you've got an asset. That's incredibly cheap money. Don't pay it off early. Invest instead and let inflation work in your favor. All right, let's make this actionable. You're sitting there listening to this and you're thinking, okay, great, but what do I actually do? Here's your step-by-step action plan using Dalio's systematic framework. Step 1, make a complete list of every debt you have. Credit cards, student loans, car loans, mortgage, personal loans, everything. Write down the total balance and the interest rate for each one. Step 2, categorize them. High interest is anything above 12%. Medium interest is 6 to 12%. Low interest is below 6%. Step 3, check your emergency fund. Do you have 3 to 6 months of expenses in cash? If not, that's your first priority. Build that before anything else, because without an emergency fund, any unexpected expense forces you into high-interest debt. Step 4, attack high-interest debt with extreme prejudice. Every extra dollar goes toward the highest interest rate debt first. This is mathematically optimal. You're getting the highest guaranteed return. Use the avalanche method, not the snowball method. Avalanche means highest interest weight first. Snowball means smallest balance first. Avalanche is mathematically superior. Snowball feels good psychologically, but costs you money. Step 5. Once high-interest debt is gone, an emergency fund is built, now you're making the strategic choice. Medium and low-interest debt get balanced against investment. Here's my recommendation based on Dalio's framework. Split your extra money. Half toward debt payoff, half toward investment. This balances the guaranteed return of debt payoff against the critical mass building of investment. As your investment account grows and approaches critical mass, you can shift more toward investment. As debt balances shrink, you can accelerate payoff. Step 6. Automate everything. Set up automatic payments for debt, set up automatic transfers for investment. Remove the decision from your daily life. Make it systematic. This is pure Dalio. He systematized everything at Bridgewater. Decision-making, meeting structures, employee evaluations, everything. You should systematize your finances the same way. Step 7. Review quarterly. Every 3 months, run the numbers again. Are interest rates changing? Are investment returns different than expected? Adjust your allocation between debt payoff and investment based on the current math. This isn't set it and forget it. It's systematic, ongoing optimization. Now let me address the psychological trap that stops most people from executing this plan. It's not that they don't understand the math, it's that they don't feel the urgency.
Debt feels abstract until you calculate the actual cost. So do this exercise. Take your credit card balance and multiply it by 0.15 if it's 18% interest. That's how much you're losing per year in interest alone. $20,000 at 18%, $3,600 per year in interest. That's $300 a month you're just handing to the credit card company for the privilege of being in debt. Now imagine what $300 a month invested would become over 20 years. At 10% returns, that's $227,000. You're choosing between paying the credit card company $300 a month for nothing or building $227,000 in wealth. When you frame it like that, the decision becomes obvious. This is what Dalio means by radical truth. Face the actual numbers. Don't sugarcoat it. Don't avoid it. Look at the cold, hard math and let that drive your behavior.
So here's what I want you to take away from this. Ray Dalio didn't build a $150 billion hedge fund by making emotional decisions. He built it through systematic, mathematical, ruthless optimization. And you should approach debt and investment the same way. The framework is simple. Compare guaranteed returns against uncertain returns. High-interest debt gives you a guaranteed return equal to the interest rate when you pay it off. That beats almost any investment on a risk-adjusted basis. Low-interest debt is different. When the interest rate is below expected investment returns by a meaningful margin, and especially when you're getting tax benefits, investing makes more sense. But you need the emergency fund first. You need to kill the high-interest debt first. Then you can make strategic decisions about the low-interest stuff. And remember the critical mass principle. Getting to that first $100,000 changes everything. The compound curve accelerates. Wealth builds momentum. This isn't about getting rich quick. It's about being systematic over time. It's about making the mathematically correct decision consistently for years and decades. Now, I want to hear from you. What's your biggest debt challenge right now? Are you dealing with high-interest credit cards, student loans, mortgage decisions? Drop a comment below and let me know. I read every single one. If you found this framework valuable, hit that like button. It helps other people find this content and make better decisions about their money. And subscribe to the channel. We're releasing new Ray Dalio deep dives regularly. We break down his principles, his investment philosophy, his decision-making frameworks, and show you exactly how to apply them to your own life. I'm your host. This is legendary investor Ray Dalio, and I'll see you in the next one.